IT stocks, TCS, Wipro, HCL Tech, Infosys all gain on the back of Accenture's third quarter results. Constant currency revenue growth climbs 1.5%. The company says they continue to see strong demand for digital manufacturing and engineering services.
Aster DM climbs after 9.3% equity changes hands in a block deal window. Sources tell CNBC-TV18 that Olympus Capital Asia investment is the likely seller.
CE Info Systems, or MapMy India as we know it, continues to gain for the second day after brokerage firm Goldman Sachs initiated coverage on the stock with a buy rating, raised the target price to 2,800 rupees a share.
GM Financial falls over 4% after it was directed by SEBI to refrain from accepting new mandates as a lead manager in public issue of debt securities until further notice.
Fertilizer stocks like Chambal Fertilizer, RCF, GNFC see profit booking after the recent run-up. Chambal Fertilizers also comes out of the F&O ban. Recent run-up was on account of expectations of a GST rate rationalization. So maybe ahead of the event, some bit of profit taking.
Hello and welcome to Chartbusters here on CNBC TV18. I'm Horbis Fatakia. With me is Mangalam Balu, and the final trading day of the week, that's the bigger takeaway, I guess, because the market remains in a range. The Nifty at 23,600 as we speak. The Nifty Bank, though, is seeing a bit of profit booking after the run-up that it has seen. Actually, the Nifty Bank is the star of the week, to be very honest. And after it's staying above those levels of 51,000 as well. So the Nifty remains in the range. 23,600 is where it is. What's doing well in today's session, of course, is IT. The top 5 gainers on the Nifty are IT names. Infosys, TCS, Wipro, Tech Mahindra, all of them doing well in today's trading session. What is also doing well is pharma, metals, and there are some underperformers as well, which is realty and FMCG. Mangalam, hi.
Hi, a lot of individual stocks actually are spiking as we speak. We have telecom stocks which are doing extremely well. Bharti Airtel has now moved towards the high point of today's trading session, and in fact, it's among the top Nifty gainers today, up around 3%. And also in the last few minutes, we've seen some pickup in the auto pack. So pick up something like Maruti, which is recovered from the lows, currently at the high point. We're also seeing some traction in Hero MotoCorp and Bajaj Auto. So both these stocks, in fact, what you do is if you just pull up the Nifty Auto Index, you would see that the Auto Index has picked up in trade and is at the high point. And also in the broader markets, a couple of themes doing extremely well. Railway continues to surge. We have RailTel, which is up around 11%. We're seeing RVNL up around 6.5%. Texmaco Rail about 6.5% higher as well. So that train, as you call it, continues to rally. But let's talk about some ideas for profit in a market like this, where we get you our colleagues from Money Control Pro to share those ideas. Sachin Pal is the one who's joining us today with a stock that he's been tracking.
Kajaria Ceramics, which is a leading tile manufacturer in the country, posted a modest revenue growth, almost 4.5% in the last fiscal year, FY24. The margins of the business continue to remain firm, around 14 to 15%. The business has outlined a strategic roadmap for the next 3 years, over which it aspires to reach a turnover of almost 6,500 crores by FY27. The tile business, which is the core business of the company, is anticipated to grow in the range of 10 to 12%, and the company will primarily focusing on the expanding its presence deeper into the tier 3, tier 4 markets to grow the business volumes. The bathware business as well as the plywood business is expected to grow in the range of 20 to 25% in the next 3 years. The adhesive business, which is an extension of the tile business, is expected to witness a threefold jump in revenues from a favorable base, almost 50 crores in FY24. Overall business continues to remain on a very solid footing, and the balance sheet is also in a very fine shape. And overall, the capex of the company, which is estimated to be in the range of 200 to 250 crores, is likely to be met through internal accruals. Well, Kajaria remains a very quality play on the overall domestic market, and investors can therefore look forward to optimal stock during corrections.
Right, some ideas for profit there from Money Control Pro. But time for a short break here on Chartbusters. Up next, we'll be joined by Vineet Agarwal, the MD of Transport Corporation of India, to discuss the company's future growth strategies. Stay tuned, back on the other side.
Welcome back. You're watching us here on Chartbusters. Let's talk about the primary market action. The IPO for luxury furniture firm Stanley Lifestyle opens to subscription today, scheduled to close on the 25th of June. The company targets about 537 crore of fundraise, of which 200 crore would be the fresh issue at a price band which is up for you on the screen. They've also raised about 160 plus crores coming in from anchor investors. To know more about the future plans of the company and growth prospects, we are joined by Sunil Suresh, who's the MD, and Pradeep Kumar Mishra, who is the group CFO. Thanks a lot, gentlemen, for joining in. And you know, that really is the first thing that the street wants to know. 200 crore is the fresh issue that you guys are raising. How will that be deployed into the business? How much of that would be directed towards store expansion? And as a result of which, what would be the sustainable revenue growth trajectory?
Yeah, thank you very much for having us here today. Most of the funds would go for store expansion. What we've actually done is in the last 5 years, we have done a cluster expansion in Bangalore and have 3 different segments in which we are playing. And then we have done the what you call as proof of concept, and we have almost a 40 to 50% market share in Bangalore. So hence we plan to kind of deploy the funds in other cities and grow more in those clusters. So we have been a pan-India brand present for more than 15 odd years in the furniture business. And we have a few stores in all the major metros, but now we want to expand in those metros.
Gentlemen, good morning. Thank you for joining in. Sunil, my question is to you. You mentioned that you would increase your presence in cities beyond Bangalore and grow in those clusters as well. Can you elaborate on which clusters are you targeting?
Okay, so we are a fairly what you call as data-driven company. We are able to understand where the premium housing is happening, in which are the major cities. It's happening in Delhi, Mumbai, Hyderabad, Pune, and Calcutta. So we plan to start expanding in these cities because our business thrives in the tailwind of the luxury housing industry. And now we see a lot of opportunity because premium housing is doing quite well in major metros, and we want to expand in these cities.
Right. So that would be one of the things that we will keep an eye out on. Also, just wanted, Pradeep to come in. Pradeep, the money that will be deployed for store opening, if you could give us a sense, you currently operate stores under 3 brands. There's Stanley Level Next, Stanley Boutique, Sofas and more. What is the average revenue each per brand of these stores? And how many stores will you open over the next 18 to 24 months and in what brands?
Yes, broadly, we have been adding on an average 10 to 12 stores per annum for the last 3-4 years. And, what we believe is that's a good growth rate in store expansion, that we see for the next 3-4 years as well. And store expansion would happen, evenly across all the 3 formats of Stanley Level Next, Stanley Boutique, and Sofas and More. Right now, the revenue is equally split between them and with a very healthy store economics. And, each brand themselves are, in a positive generating P&L. And I think with more store expansion across the year, we will want to continue that same momentum.
Right. So I'm just, going back to the first question that I asked, which was with regards to sustainable revenue growth. I'm looking at your revenues and the number of stores that you currently have. On an average, the revenue per store is anywhere between 7 to 8 crores. If you add about 10 to 12 stores every year, that means an additional revenue of about 80 to 90 crores per year. Would that be a sustainable growth trajectory to look at in terms of store addition? And what else are you penciling in when it comes to same store? Yeah, go ahead.
So
Stores take about 4 to 4.5 years to fully mature. So currently we have almost 60% of our stores under 2 years, and they're still in maturity age. So technically, as we keep adding more stores, I think the revenues from the current stores which are maturing, plus the new stores will also increase in terms of how we see the business.
Pradeep, I wanted to ask you about the store expansions. You were mentioning that you plan on expanding into cities like Delhi, Mumbai, and in markets like these, the rent is mostly shooting through the roof. And what is your rent expense as a percentage of your stores? And would that increased rent expense and real estate cost be a risk to your profitability as well going forward?
Yeah. So currently my rent expense, is somewhere between 9 to 11%. We typically, when we operate and when we identify location, that's a very, very important driver for us. We operate out of very large showrooms. We need that much of space to display, our products and, to give the experience to the customers. So I think that's a very important piece. And I think when we expand into new geographies, location and rent cost is a very important aspect. So we decide, the location is important here. And of course, getting the right location at the cost that we want is very important, aspect of the overall retail business. Not only for us, but for the retail in general.
All right, so 9 to 11% is your cap on the rent that you're willing to pay as a percentage of sales every store. I'm looking at your margins over the last 2.5, 3 years. They've been anchored around that 18 to 20% mark. What are the triggers for margin expansion from here on? And, how are you likely to look at margins at a store level, at a company level, franchise versus own stores? Sunil, you can go for it.
Yeah, sure. So basically, when you really look at what we are doing is the 5 major metros, we have decided to have only company-owned, company-operated stores. There we are expanding on a cluster basis. In our entire B2C, we are a 100% cash and carry company. So including to the everything that we sell to the franchisee is completely sold out in terms of the model itself. So while we have a lot of inquiries for franchisees all over the country, we're very careful because in the segment where we are playing, it's very important to ensure the market is ready. Sometimes there are smaller towns and cities which are closer to major metros, and the catchment in the segment where we play, the customers normally travel to the major cities and do the purchase there. So very carefully we are growing in terms of COCO as well as FOFO model. So from a margin expansion, what we have really done is we were originally known more as a living room or a sofa brand for almost 10, 12 years. But last 5, 6 years, we have invested in a manufacturing facility capable of manufacturing complete solution for the home. So we are able to provide furniture for every room of the home. That means kitchen, wardrobes, beds, mattress. So we are actually becoming a one-stop shop for a premium and luxury home. Thereby, the average ticket size of a customer who spent about 2 to 3 lakhs with us about 3, 4 years ago is now becoming almost 5 to 7 times more. So that is the way we are expanding our business.
Right. Pradeep, I wanted to ask you about your working capital days. They are currently seem to be on the higher side, and they're stuck because largely in inventory. How do you plan, if you can share a number for that as well, and how do you plan on bringing that down?
See, my average inventory holding in absolute term is, pretty high. And then that number, when you see, when I say it is very high, it is also to understand that these are the inventory which is logged in display inventory when I open a new showroom. So as we expand, for the in geographies, this number in absolute term will keep increasing. And I think, when we do a 15-20,000 square feet of showroom space, it requires a lot of product to be placed in the floor. And actually, that's a kind of an asset that we have where we are able to give a lot of customization offerings, wide variety of choices to the customer. I think what happens is when the store becomes fully matured in 3 to 4 years' time, then we see the real impact of inventory turnaround, really paying off. So we need the stores to get matured for these days to come down.
We still haven't
Carry some raw material inventory, yeah.
All right, we still haven't gotten a number from you, so I would just, you can say yes or no. Sunil, with the 25 stores that you're planning to add over the next couple of years, given your current store revenue run rate, is an additional 180 to 200 crore of top line possible because of these new stores in the next couple of years?
Like I mentioned, I think we are targeting 1,000 crores in the next 3.5 years. Like I also mentioned to you, most of the other stores which are not fully matured are going to come to maturity. So we believe that our business, about 80% of our business is B2C and 20 is B2B. That formula will continue, and we are targeting 1,000 crores in the next 3 to 4 years.
All right, 1,000 crores on the top line in the next 3 to 4 years. That's the headline coming in from the management of Stanley Lifestyles. The IPO opens for today. The company is seeking a post-listing market cap of close to 2,100 crores at the higher end of the issue price band. Thanks a lot, gentlemen, with a promise to speak once again when the stock lists, and then we get details and more numbers out of you. With that, we'll slip into a short break. On the other side, we have the management of Transport Corporation of India, Vineet Agarwal, the MD, waiting by.
Back with us here on Chartbusters and on to another corporate conversation then is turning our attention to logistics solutions provider Transport Corporation of India. The company's managing director Vineet Agarwal joins in to discuss the future business outlook and a peek into demand expectations from the upcoming union budget as well. Vineet, good morning. Thanks a lot for joining in. Now, I'd want to ask you firstly about your outlook for FY25 because in FY24 you grew at around 6.4%, which was slightly lower than your range of around 8 to 10%. Do you see that reverting back to those levels in FY25? What's your view there?
Always good to be here when we are not talking about earnings. Last year was expected to be a little slow because of the impending elections and just the global market will also slow down, which had some impact on India. And of course, consumer sentiments in India were slightly weaker as well. Our trajectory of about 10 to 15% on the top line should continue this year. As well as 10 to 15% on the bottom line as well. So yes, the margin was slightly compressed last year, but overall we still did reasonably well and the businesses all grew and we had a very strong position to take this forward.
All right, 10 to 15% growth on both the top line and the bottom line would imply margins around that 10 to 11%, which would sustain. Let's talk about the Seaways division though. I mean, there has been a lot of international uncertainty. People are talking about geopolitics, etc. What routes do you operate and was there any impact of crisis on your performance? How have freight rates panned out in the Seaways business?
Our Seaways business operates domestically. We operate on the west coast with ships operating from Kandla to Cochin and on the east coast from Vizag, Chennai to Port Blair. So the international rates don't really directly affect us, but indirectly they do. We know that the crisis that happened is happening right now in the Middle East. The Panama Canal recently had a crisis where they were actually struggling to have enough water for the ships to pass through, which is now resolved. But all of these have led to an increase in prices globally for ships as well, not just container rates. And that has an impact when we are trying to acquire ships. Clearly, the impact is also there indirectly on fuel because fuel is a direct correlation of what is happening in the Middle East, for example. And that has an impact on India as well, where the bunker prices have gone up. Though the fuel prices on our pumps are not gone up, but on the bunker level, the prices have gone up as well. So there has been a slight increase in freight rates on the domestic sector, but not really that impactful. However, the acquisition of ships has been very difficult. We've been looking to buy ships for a long time now, and we've just not found the right ship or the right quality. We've also looked at buying new ships and giving orders, and we're in the process of discussing and trying to finalize some of that.
What could be the reason behind that, Vineet? The struggle behind the lack of ships for acquisitions? You've been placing new orders as well, but when do you expect that to fructify?
Actually, the new order that we had placed had got cancelled by the shipyard, actually, because they had some issues with their banks. However, we're in the process of looking at new orders, which should start happening and should deliver if everything goes through by the middle of 26. However, the second-hand ships, which is typically what we tend to buy, those are not available because they have been plying on several trade sectors, which are short trade sectors. We don't buy the very large ships. We buy little mid-size container vessels. So it's the international crisis that has really driven these prices up quite substantially.
So 26 to 27% margin in the shipping business likely this year?
That's right. I think that should continue. The business is stable. The capacity is, we don't have extra capacity, but the rates are also stable. So I think this margin structure should continue.
All right. I just wanted your thoughts on two verticals which you recently entered into, the potential, the rate at which they're growing and the targets that you have for the next couple of years for this one. You did almost 90 crores in the cold chain business in FY24. That is a fast-growing business. What are your targets for this business over the next 2 to 3 years? And also chemical logistics. You entered that business last quarter as well. So what are your targets here in terms of revenue contribution?
The cold chain business is very exciting. I think in the next few years, we are going to see a dramatic shift of consumer trends towards more and more processed foods, as well as the fact that there is QSRs that are growing. Chemicals are themselves require certain kind of cold chain, as well as even semiconductors might require cold chain in the future. So the potential is massive, and we are looking to grow at about 20-25% CAGR for the next 2 to 3 years. We made a substantial investment last year by investing 75 new trucks in this space. We're adding cold storage capacity as well. And this augurs very well for the business in terms of the next 5-10 years. It's a high growth business. The second is chemical logistics. Again, chemicals in India has been very much fragmented in terms of the logistics. There have been more unorganized players that have been there. With the China Plus One strategy, we are seeing chemical companies also adding capacity in India, as well as Indian chemical companies growing and wanting world-class transportation and logistics best practices. We are providing those now. And we've been doing for some years, but now we've structured this into a more definitive entity to grow this business forward. And it is, again, an extremely exciting space as well.
Very quickly, we need, due to paucity of time, 10 to 11% margins is a reasonable target to achieve for FY25?
Yes, it is. That's the short answer. However, being here, I would definitely like to take the opportunity to tell you that the budget needs to have a lot more focus on infrastructure. The need for infrastructure for logistics is imperative. That's the only way we can actually reduce the logistics cost, by moving towards more multimodal logistics, and hence infrastructure is very important.
All right. Thanks a lot for joining in, and we would have liked to speak with you a lot more, but due to paucity of time, we'll leave this conversation right now with the promise of more after the budget is announced. Hopefully some softs coming in your way for the logistics sector as well. With that, what we'll do is we are out of time on this edition of Chartbusters. From Hormaz, me, the entire team, thank you so much for watching. In the while we were talking to the managements, the market has slipped a little further. The Nifty is in the red, as you would see at the top of your screen shortly, with the Nifty Bank lower by almost 0.75%. The mid-cap index is holding up, but not with as much gains as it was about an hour ago.